Welcome back to the Master's Certificate in Technical Analysis. My name is Stu Wisson and we're at Module 9. Module 9 is talking about Elliott wave and cycles of time. I think you'll see once we've gone through this video that we're starting to tie together all the different aspects of technical analysis, and we're coming up with a complete picture or a holistic view of the way the markets work. But you'll see that more as we go through this module. This video module is part 1 on Elliott waves. We're talking about Elliott waves. Elliott invented his waves in the 1930s. They were really popularized, I think, around the 1970s when a book came out which I think referred to them, but they really are certainly popular and they have a huge following. You can Google them on the internet, and there are various groups that swear by Elliott waves. Elliott waves are essentially very simple. They may not always appear to be very simple. There's a lot of debate about where and when you see them and how they work out, but they're a very simple concept, and they basically build up on a lot of previous work which we've covered. Elliott started from the Dow theory, and that's exactly why he calls them waves. Dow was very big into the idea of prices going like the sea and the tides coming in and out, and that's the big move, and then you have the waves coming on out of the smaller moves. And there are levels of moving, so Elliott called these levels waves because he was building on that. He was also building on the Fibonacci series. Fibonacci was an Italian who lived around about the 13th century. I don't think he actually invented. I think the Greeks actually knew it, but he was the first one who first formalized the Fibonacci series of numbers, which in one of the forms is actually the number of which in one of the forms, and rather bizarrely, is the number of rabbits you get if you allow them all to breed freely, and the number of series multiplies out very quickly. But its numbers coming up a lot in nature, and you have books about Fibonacci, and I recommend, if you have spare time, to read about them, because it's actually an amazing mathematical phenomena. Now, going back to Elliott wave, this is fundamental. This is all you really need to know. An Elliott wave, I've shown it here, is in an uptrending market. It's just the same in a downtrending. Obviously just inverted. Elliott waves, you have waves 1 through 5 going up, and you have waves A to C go back down as a correction. Waves in Elliott terms are straight lines, as in this case number 1 is a wave, 2 is a wave. So you may be thinking a wave is a peaky thing. It's not, it's just a straight line. So you have 5 waves. These are 5 waves going up because he's numbering the line A, B, C are going down. The ones that are following the trend, 1, 3 and 5, and also A and C, the ones that are going with the main trend, these are called impulsive waves. They're going with the impulsive or the impulse of the trend, and the ones that set back a little bit, the corrections, 2, 4 and B, these are called corrective waves. So you have the impulse and the correction, the impulse, correction, the impulse and the main thrust up, and then you have a correction coming back down, which is made up of an impulse, correction and an impulse. Now the clever thing with Elliott wave is that they can be scaled up and down. They don't just exist on this level. This might be a chart that covers weeks, but you can break it down to when you look at it. You can have the same chart here, but seeing the micro movements of price. And if you see here exactly the same thing, you see 5 waves going up, 3 waves going down. 5, then we go to the peak, then we have the impulse wave made up of 5 waves again, 3 corrections and 5. So I think you can scale it up and down many times. I think Elliott named about 8 different scale of Elliott waves. And so you get the Elliott waves making up another Elliott wave. It's all a little like the chaos theory if you read about that. That again is another fascinating subject that you can read about. It's not quite, but it doesn't go into the infinity like the chaos theory, but it is the same scale of the usual, something up a scale or down, and you'll get the same shape happening. And as a point of note, the correction wave here is made up of 3 waves. 535 correction waves are always 3 waves. If you expect a correction wave and you see 5 waves, you've got something wrong. Or if you've just, as we've shown here, it could be the first wave of a 3-wave correction, but the first wave is broken into 5. So you always get the 3 main moves in the correction, not 5. Now, talking about correction, it's actually a little bit more confusing than the main thing, and we'll get into that. Zigzags. The zigzag is the usual correction which I've shown you, one with an A, B and C, which breaks down into a 3-wave down, 5-way correction. That's 535. You could also get something called a flat, which at first sight is very similar to a zigzag. C comes down just a little bit below A. It's a flatter shape than the zigzag, but the main difference with the flat is that the 3 is that it's a 3 and 5. It breaks down into 3 waves down, 3 waves correction, and then a 5-wave on the whole. So they're basically different, but again it's got the 3 major waves of the correction. And the other type of the correction is the triangle. It represents the balance between the buyers and the sellers. They're just jiggling along the price and no one really is dominant. And usually the triangle gets narrower, and you'll see lessening volume as the triangle gets narrower. And you'll see quite often that triangles are the 4th wave of the trend before the push of the 5th wave, and so triangles are known to be both bullish and bearish signs because they're immediately bullish. The triangle happens and then you go off for another push. The 5th wave is a push in the trend, but they're also bearish because you're getting to the end of that bearish trend. You'll also get the 5th wave, then you're going to get the 3-wave correction coming back down. Now I'll just show you here a triangle. This one is called a bull market ascending. This one is ascending because it's basically going up. You have a horizontal top line and you have an ascending baseline. To be a triangle, to form the thing, you need 5 touches. This one actually shows 6, but you need 5 touches of the triangle to actually give you the shape. It's a bull market ascending because the price comes up into it and goes up out of it. And you can get variations. You can see them in the text. I haven't put them on the slides, but that's not really necessary. You can have a bear market ascending, and that's really the same because the price goes down into it and then goes down out of it. So it's a bear market going down. You can have a descending triangle, which is a horizontal base, and a descending top line, and it again can be in bull or bear form. And you can have a symmetrical triangle, which is between the two. The top line goes down, bottom goes up, and again it can be bull or bear. Finally, we can get a reverse symmetrical triangle, which I think we talked of as a broadening triangle, and that's where the triangle is the other way round, coming to the small end of the triangle, and the triangle broadens out as it goes along, and again that's bull or bearish. So that's the 8 basic shapes of triangles that are recognized again. This is a lessening in volume typically. As they go along, there are continuations. If it looks familiar, you'll probably remember it from Module 4. We went into triangles there, and we looked at reversal and continuation patterns, and this is a continuation pattern. One final point is to remind you that when you're looking for price target, you look at the size of the base of the triangle, and you expect the breakout to go at least that far. We have covered the continuation patterns too, I think. This is one type of triangle left, and that's just called a diagonal triangle, and that's where it's totally at an angle as shown here. Excuse me. And that's often wave 5, and it's also called a wedge. You can see again 1, 2, 3, 4, those can be broken down into other Elliott waves, but here we've just broken down into wave 5, which is 3, 3, 3 and 3, 3 pattern, and that's called a wedge. And the top of that, of what we start, the 3-wave correction. One other thing to mention is the rule of alternation. I've seen some different definitions of this, but the one I think is the official definition is that pattern happens alternatively. If you get a complex pattern once, the next pattern will be simple. You'll find things don't always go in the way you'll find that alternately they'll change over. Elliott also was into channels. Again, we looked at channels previously, and channels way back with trends, and I hope you still remember all that stuff. Elliott used channels for price targets. As you know, we expect the price to bounce between the top line and the bottom line, and it also to help count how many waves we have had and how many peaks and how many troughs were there too. So that's the wedge. Now we move on to the Fibonacci, and if you're not familiar with it, it's an interesting idea. It's very simple. You start with 2. You start with 2 ones and you just add the last 2 numbers together to get to the next one. So 1 and 1 makes 2, 2 and 1 makes 3, 3 and 2 make 5, 5 and 3 make 8. And you can just do it in your head. And as you go along, the ratio between the 2 adjacent numbers gets closer to 1.618 or something like that. Or if you look at the ratio the other way, it's 0.618. Interestingly enough, if you're into mathematics, you'll probably recognize that as the golden ratio. They used to make buildings out of that supposed to be very pleasing rectangle to the eye. So you would have an arch, and that's the 1.618 high and 1 wide, and it would look very good to the eye. In fact, you can even use the golden ratio to make what they call a super ellipse. Sort of ellipse, but in fact the sides are pushed out of it. Peter Hine designed some roundabouts for roads using super ellipse, and apparently it's best for traffic flow. Again, if you're into math, find out all about this and all these sorts of things, as well as in nature. And apparently the number 1.618 and 0.618 are also much used in our trading. Look at the charting software. You'll find that there's something to allow you to draw Fibonacci lines very easily. You don't have to go measuring these things. You just pull a Fibonacci line from a trough to a peak, and you'll see the intermediate lines that are already drawn for you. So I'll show you here. That's the intermediate Fibonacci line that's drawn up. I draw from the base there and labeled 264. I guess that's the value there, up to 370. And as you can see, it's already drawn the lines in between where the appropriate ratios. And you can see that those lines actually, they hit quite often if you look over there. In the middle of the graph, it doesn't quite come down to November, but just to the right of that, in the middle of December, it comes down and touches on that line just to the right of that. You can pull that out a few times and see which one fits the best from the bottom to the top, and you'll see intermediate lines. Fibonacci is also used in time to some extent. Time is the least important part of the Elliott wave theory, but you can also use those numbers to say 13 days, 21 days, 34 days, and you'll find sometimes that something significant happens if you look at the gap in the graph. So again, that's another way to look at it. And there are oscillators that you can set periods of oscillators to Fibonacci numbers. So Elliott waves basically, they're concerned with the pattern, the 5 and 3 and the ratios, and then finally in terms of your significance, you'll look at the time you're happy to apply these Fibonacci numbers to time. Corrections are always 3 waves, and the target retracements based on Fibonacci will be 38, 50 and 62. So that's where those numbers come from, which we mentioned back when we talked about the retracements in one of the earlier modules. That's all there is to Elliott waves, but you'll find yourself involved in discussions about whether this really is an Elliott wave or whether this is a retracement or whatever. People do argue about how big the moves have to be for each scale of Elliott wave, but you can certainly join a group that's into Elliott waves, and they'll show you how and what they think what they should be. You won't find a computer program that will draw you Elliott waves because they're very subjective, but it is a worthwhile thing to know. We'll go on to part 2. We'll finish the video, and part 2 of module 9 will be timescales, how time figures in all our trading. Again, we're sort of bringing things together in we're sort of bringing together all the things we've been discussing, and you'll see how they relate now that we're getting into the later modules, how everything works together. So I look forward to talking to you, which we'll get straight on to right now rather than pausing. So here we are with module 9 part 2. this is where we're basically talking about cycles of time. Time cycles, well, as we know, they're all around us. Obviously, day and night is a cycle. Biorhythms, those are the cycles where you have 28 days for health and 33 days for emotions and things. We have cycles around us, the seasons, the annual cycles, everything runs around cycles. Now in trading, cycles are used for oscillators, for moving averages. And also we have time as such proves support and resistance. For more times these things are hit more, the more proven those levels are to be able to sustain and bounce back the price. Time is very important in all these things, and the people who look at the people that look at this are called cyclic analysts. They're not only traders, but people who look at the cycles in everything, and as I say in the text, they also write books about it. Some examples of cycles are 18.2 year cycle, which can be applied to marriage, to sales, and to construction, and to stock prices, and a whole host of other things. People looking for these cycles can find them everywhere. Cycles have three basic values. One of them is amplitude. Imagine, as I say, a sine wave. Amplitude is how high a wave is, so that's the first and most characteristic part of a cycle. The second one is a time period. How long does one sine wave go one? One may go a few weeks, which we normally do is measure the length from the bottom of the cycle wave to the next bottom as the most reliable method. So the next time be 20 days or 40 days, and that's another thing that defines a cycle. Now another thing that defines a cycle is a phase, and a phase is a relationship in the wave and some other things. So you have two cycles, and a relationship is how far apart the bottom of those two cycles are, and that's called the phase. Cycle principles. Now the theory goes that price patterns can be drawn from adding all the cycles. So if you get enough cycles and you can identify them, and then you add them all together. So the first principle is summation. So you have a 40-day, a 20-day and a 10-day cycle and add them together, and you get a more complex shape than the sine wave, and this summation will show the price curve. The second principle of the 6 principles is harmonicity. I didn't invent these names, and they're intriguing, but harmonicity is a principle of cycles that says that cycles are usually related very simply, like when you see a 20-day and a 10-day cycle, so they're just apart by a factor of 2, or maybe 3, but you can also, if you have a 10-day cycle, you'll certainly find a 5-day cycle again by a factor of 2. So harmonicity is a principle of cycles in trading. And the next principle is synchronicity, and that one says that if you have waves of different periods, they tend to all bottom at the same time, so they tend to synchronize themselves. So after a period of time, they'd all bottom at the same time and then go into cycles and come back and bottom again at the same time if they've had enough days. The fourth principle of cycles is proportionality. It says that if it's a longer cycle, a longer time period, then the amplitude is going to be too big. So if you look at it, if it's a big cycle, it will have a big time period, and if it has a big time period, it will have a big height in the cycle. But the period and amplitude are related. But having said those 4 rules, we have another one that says variation. Variation says that cycles don't have to obey any of those rules. This is just a tendency, so don't rely on those things happening, but look out for them. And we also have a 6th called nominality, and that actually says that there's a set of common cycles on the market that are based on 18 years. Perhaps this also refers back to that 18-year rule for marriages and real estate. It's also close enough. And they also say that 18 years is a cycle length, and you can have half that to 9 years, and you can also have that to 4.5 years. So you can look to 4.5 cycles in the 4.5 years cycles in the stock market. Interestingly enough, once they get down to 4.5 years, they don't say that you divide it by 3, but you get down to 18 months, and you can expect to see another cycle based in 18 months. Then again, if you keep halving it again, so you expect to see 9-month cycles and 4.5-month cycles and so on. So normality actually gives us a time scale that you expect to see in the market. Now here are some notable cycles. The most notable cycle is the Kondratiev wave, which is a 54-year cycle. I think it was a Russian economist in the early 20th century decided to take it on for himself to go to 1789 and see prices of commodities and copper and the markets, and he somehow managed to trace that these run cycles of 54 years. And you'll also see a lot of skeptics remarking about it, but it's interesting that someone actually worked it out, and he was quite convinced that cycles ran in 54 years, and he ran across a lot of things like global prices and things like that. The next cycle we'll talk about is presidential cycle. This is obviously 4 years. For the Americans, they know that we have elections every 4 years, and the British may not, but because the British take elections whenever they feel they can win. But in America it's strictly every 4 years, and therefore you see prices every 4 years. Obviously pre-election is a good economical year. If nothing else, the president will try to make a good economic year so that he can win again, and the election usually is a good year, post-election year, and the one after that is also good, and the rest are usually down years in the market, so that gives us a 4-year cycle. And then, having said that, obviously there are seasonal cycles, annual cycles. They affect a lot of things, particularly commodities. Soybeans, for example, can expect to see a topping of price between April and June, and a bottom between August and September, and that's based on the season of growing soybeans. You can see peaks around October, and then after the winter prices will drop off. So this relates to seasonal cycles. Other things like the copper, silver, gold, and even the dollar are usually at a low price in January, so you can expect things don't seem to be related on an annual cycle. And one cycle I think we've always come across before is the commodities cycle, 28 days. That's the calendar days actually. It's more like the 20 trading days, but if you remember we talked about the 4-week rule in Module 6, which is a very simple trading system based because we tend to look at things in 28 days on commodities. And 4 weeks rules say that if a price goes up in the 4 weeks, then you jump onto the uptrend on the 20 days, depending upon whether you include the weekends. Some people have suggested that you should buy just based on the moon, the lunar cycle, because those are 28 days, and the moon certainly in its influence is powerful enough to move the tide, so who knows. But 28 days is a notable cycle in trading. If you want to find cycles for your trading, you can probably find them on your charting software. If you click on a thing called cycles, you can start on one side of the screen and on a notable bottom, and then pull it out the side and draw the equidistant, equally spaced lines. I started over on the left there in May, and as you can see it was a bottom, and as I say, we usually try to relate the bottoms to more reliable ways than the tops. So we see the third line across in July that hits the bottom. The first line in August just misses the bottom, but in September there's a bottom. There's some break and some remarkable stuff between October and November, and then another bottom in December and in January, and another in February, so certainly trading downwards on the right hand line there. So you can see there's a definite cyclic pattern between the lines here, and that's one use of the cycles. If you find a cycle that tends to be related to how the prices are going back down, you can use that and can say, well, I expect the price to go down. Maybe a buying opportunity for, I think that is basically an uptrend. We'll wait for that price to go down, and then we'll buy long, and we'll know we've got the best price we can get before we ride back up on the uptrend. So that's one way of using cycles in trading. It's very simple and very quick. You can just use computer to do that, or it's one of the better ways because you have to go into there and try lots of different cycles, which is very quick for us. Then computers can do it in better ways because people are much better at spotting patterns than machines, which is probably why it took so long for chess computers to win, because chess is always won by spotting patterns, and computers just had to crunch a lot of numbers to beat the chess masters. Another way to use cycles is moving averages. Again, if you find a cycle on a stock chart, you might want to set a moving average to that cycle at a 40-day cycle, and set a second cycle for a simple harmonic relation in that, like 20, for instance, in 20-day cycle. and then just use a double crossing for that. And if you do that, you'll find that the system works more accurately. So we need to identify cycles so we can use it that way. We can also use them for oscillating periods. We can set an oscillator period to see how it works out. You can set the oscillator period to one of those cycles that you identified on the price charts, although with oscillators you have the price of using Fibonacci numbers, so you can use either 13 or 21 from those. So there are a couple of ways to approach it and what works out best. But certainly, as you can see, cycles have a big influence on prices, and you must bear in mind and look for them and try and use them in your trading. That's the end of our talk about cycles. The next module, module 10, is a really great module in its, and we'll be talking about cloud charts, the Ikimoku technique. I'm not sure if that's quite the way the Japanese pronounce it, but it's just one of those Japanese methods that's been discovered in the West, even more recently than candlestick charts, and it's a terrific trading method that a lot of people are now looking at and trying to find out about it. Also, a lot of charting software are producing it, so we have a whole module dedicated to looking at this cutting-edge latest thing called cloud charts. So I look forward to talking to you then with this cutting-edge latest thing. Goodbye for now.